Bitcoin has done something that seemed impossible to many observers just a few years ago. It's become a serious topic in institutional finance. Major asset managers offer Bitcoin ETFs, corporate treasuries hold it now, and its price has, at various points, exceeded $90,000 per coin, a level that would have been dismissed as fantasy a decade ago. But here's the question that actually matters for traders and investors. Is Bitcoin a risk asset or a store of value? Because the answer to that question determines everything about how you position around it, when you buy it, when you sell it, and how much weight you give it in a portfolio. In this video, we're going to build the framework to answer that question clearly, and we will not sit on the fence either. By the end, you're going to have a specific view. The strongest argument for Bitcoin behaving as a risk asset comes from its historical price behavior in the macro environment. For much of its public trading history, Bitcoin has moved in close correlation with high growth technology stocks and other risk assets. When the Federal Reserve was cutting rates and liquidity was expanding, Bitcoin surged. And when the Fed raised rates aggressively in 2022, Bitcoin fell approximately 65% from its peak. At the same time, the Nasdaq fell nearly 33%. This is not coincidence. It reflects the same mechanic. When the cost of money is low and liquidity is abundant, capital flows to higher risk, higher return assets. When liquidity tightens, risk assets get sold, and Bitcoin, as a high beta risk asset, gets sold harder than most. The 2022 data is perhaps the clearest proof. During a genuine flight to safety, Bitcoin fell while gold rose. That's not how a safe haven behaves. The counter argument rests on Bitcoin's monetary properties, specifically those it shares with gold. Bitcoin is a fixed maximum supply of 21 million coins. No government can print more. No central bank can debase it. Its issuance schedule is determined by code, not by politics. These properties, scarcity, predictability, and independence from sovereign monetary policy, are the same properties that make gold attractive as a store of value. Proponents argue that as trust in fiat currency systems erodes, as governments run persistent deficits and central banks expand balance sheets, Bitcoin represents a digital alternative to gold, an asset that cannot be inflated away, can't be seized through traditional banking system, and whose supply cannot be expanded by any authority. The adoption of Bitcoin as a reserve asset by certain governments and the scale of institutional inflows via ETFs since early 2024 provide genuine support for this narrative. When sovereign wealth funds and major asset managers allocate to Bitcoin, it begins to look less like speculation and more like reserve management. The honest verdict is this, guys. Bitcoin currently behaves primarily as a risk asset, but it has the structural properties of a store of value. This distinction matters because behavior is what traders need to navigate, while structure is what long-term investors need to evaluate. In the short to medium term, watch the Federal Reserve. When the Fed is easing and the dollar liquidity is expanding, Bitcoin has a structural tailwind. When the Fed is tightening, Bitcoin faces a strong headwind. The correlation with tech stocks and the inverse correlation with the dollar are empirically robust. In the longer term, the store of value case depends on continued institutional adoption, regulatory clarity, and most importantly, whether Bitcoin's behavior in the next major financial crisis resembles gold more than it resembles tech stocks. That test has not been run definitively yet. For traders today, follow the macro. For long-term investors, watch the institutional adoption curve and the regulatory landscape. For market participants, the practical question is which macro variables are the most predictive of Bitcoin's direction. The Federal Reserve rate cycle has the strongest observable relationship. Bitcoin tends to outperform during easing cycles and underperform during tightening cycles. This is more reliable than any technical signal. The US dollar index also matters. A strengthening dollar tends to create headwinds for Bitcoin, consistent with the risk asset interpretation. Dollar weakness is generally supported. Risk sentiment, measured by the VIX and the equity market direction, is the most immediate driver. When the VIX spikes sharply, Bitcoin typically falls alongside equities. When risk appetite is strong and equities are rallying, Bitcoin tends to participate in the move, often with higher amplitude. The one variable that has been less predictive than many expect is on-chain activity. While interesting for understanding the Bitcoin network, on-chain metrics have had limited predictive power for the short-term price direction in a market now dominated by institutional positioning. Bitcoin above $90,000 is not a bubble and it's not uncertainty. It's a genuine novel asset in the process of establishing what kind of instrument it permanently becomes. For traders, It's a high beta risk asset that follows the macro cycle. Trade it accordingly. For long-term investors, the question of whether it becomes a genuine digital store of value alongside gold will be answered by institutional adoption, regulatory development, and crucially, how it behaves in the next true financial crisis. The debate between risk asset and store of value is not academic. It determines your position size, your holding period, and your exit conditions. What is your view on Bitcoin's identity? I really want to hear this, guys. Drop it in the comments below. This debate is worth having. We'll see you in the next video.